Hello viewers, my name is Ashok Sen Gupta from School of Management Sciences, Lucknow. Today's class is also based on dividend model. It is a continuous series and today we will discuss the dividend model part 4 in your subject financial management and corporate accounting in MBA syllabus. In previous class we discussed about the relevance theory and irrelevance theory. Irrelevance theory said there is no impact on share prices of company if you pay the dividend or not, but relevance theory criticized this and said there is a impact of on share prices due to the payment of dividend. The first model given was I discussed in previous class was Walter model, and today we will discuss the another model which helps to justify the relevance theory. So, let us recap. The relevance theory of dividend argues that dividend decision reflects the market value of the firms. Therefore, dividend matters. डिविडेंड मैटर रखता है. अगर ऐसा नहीं होता तो कंपनीज डिविडेंड देने में आनाकानी करती क्योंकि उनके शेयर मार्केट में कोई फर्क नहीं पड़ने वाला. बट डिविडेंड मैटर्स. थ्योरी सजेस्ट दैट इन्वेस्टर्स आर जनरली रिस्क एडवर्स. इन्वेस्टर रिस्क नहीं लेना चाहते हैं एंड वुड रादर हैव डिविडेंड टुडे. वो आज अपने हाथ में डिविडेंड चाहते हैं. अगर आपने फर्स्ट ईयर है मतलब फाइनेंशियल ईयर में ही रिजल्ट डिक्लेयर हुआ कंपनी का एंड दे नीड डिविडेंड. एक कंपनी अर्न प्रॉफिट दे एक्सपेक्टेड द डिविडेंड फ्रॉम द कंपनी. देन पॉसिबल शेयर्ड एप्रिसिएशन एंड डिविडेंड टुमारो. वो आज चाहते हैं अपने हाथ में डिविडेंड. कंपेरेटिवली फ्यूचर में शेयर प्राइसेस बढ़ें या फ्यूचर में उनको डिविडेंड मिले, वो दे आर नॉट बॉदर अबाउट दैट. एक्चुअली द नेचर ऑफ द इन्वेस्टर इज डिफरेंट. I already discussed in previous classes that some investor need dividend to meet out their day to day expenses. Some investor feel that dividend is a kind of earning for them and they use the amount of dividend received as a part of their earnings. Right, retired person, widows, all. For them, if you said we will provide a dividend after a year or in future in a financial year, then they will never be satisfied with that. So, they always expect the possibility of dividend tomorrow, today in compared to tomorrow. Therefore, according to this theory, optimum dividend should be determined which will maximize the wealth of the shareholders. एक ऐसा मॉडल बनाना चाहिए जिससे कि कंपनीज अपना डिविडेंड भी दें, उनके बाद रिटेन अर्निंग्स भी रहें और शेयर मार्केट में शेयर होल्डर्स का वैल्यू बढ़े. कंपनी मस्ट वर्क ऑन दैट. दे हैव टू टेक द डिसीजन, दे हैव टू मेक द प्रॉपर स्ट्रेटजीज where they feel that they suggest that such amount will pay to the dividend holder, such amount will make the retained earnings, and by doing so our wealth increases, share market increases, and the dividend holder shareholders will satisfy. So, these decisions is so much important for a company because nowadays A good investor having a knowledge, he or she collect the knowledge from different sources about the companies, about the working of the companies, about the information of the companies, and it is a duty of the company as per the guidelines of the SEBI to disclose the financial decisions, to disclose the financial result without delay to the shareholders. So, whenever company doing anything, any changes, any decision making, any ups and downs, it is reflect through different media. People have a smartphone nowadays, they have apps, they have news through financial news, and those who are really interested in share market, those who are invest huge amount of share market, they keep watching the day to day functioning of the companies. So, in this case, company not able to tolerate any kind of, company not able to misguide the investors. Okay. So, today we will discuss Gordon approach. According to the Gordon model, dividend is relevant and dividend policy of a company affects its value. Dividend policy of company affects its value. Assumptions of the model: firms is all equity firms, no debt. First of all, it is very important, all firms are equity based, they do not have a mix of equity and debt. Second, IRR, internal rate of return, will remain constant because change in IRR will change the growth rate and consequently the value will be affected. Hence, the assumption is necessary, IRR must be constant, internal rate of return must be constant. On the other hand, KE also must be constant, KE remain the same. What is KE? Cost of equity or discount rate. In this model, retention ratio is denoted by small b. Once decided upon is constant, that is, constant dividend payout will follow. If retention ratio b is constant, then dividend payout also constant, because whatever we retain, if it is constant, then the remaining part of that earning we pay as a dividend. Growth is G equals to BR. Here growth is denoted by G, which is equals to BR. What is B? B is retention ratio and R is internal rate of return, IRR, which is in the function of these two variables will remain effective. So, here we take different variables like B. G equals to BR. So, B is retention ratio, this is IRR, clear. So, these are the variables in the formula. Remaining assumptions: K is greater than G, cost of equity greater than, this assumption necessary and based on the principle of series of geometric procession of n of the years. All investment proposal of investment financially through retained earnings. This is also important. All financing decisions are based on retained earnings. There is only source of finance, this is which is retained earning. So, formula generated here is, I write here clearly, P naught, that is price of the share, equals to earning 1 minus B divided by KE minus BR, KE minus BR. So, 1 minus B reflect the dividend payout, 1 minus B is equals to dividend payout. Clearly, because B is retention, B is retention. So, when B is retention, then 1 minus B is dividend payout. Let understand, according to Gordon model, when IRR is greater than cost of capital, the price per share increases and dividend payout decreases. When IRR is greater than KE, price per share increases and dividend decreases. On the other hand, when IRR is less than KE, then cost of the capital and the price per share both decreases and dividend payout increases. And in third case, there is constant. If R is equals to KE, then there is no optimum ratio. There is no optimum ratio. So, company's growth is optimum dividend payout is 0. Companies decline when R is less than KE and you have to pay whole the dividend to maintain the prices. Here the question arises. Here the question arises. Profit 30 lakhs, outstanding 12% preference share 100 lakhs, number of equity 3 lakhs, return on investment 20% and cost of KE 16%. We need to find out the dividend payout at 25%, 50% and 100%. We need to calculate the price of the share. So, profit is earning, profit is net profit less payment to the dividend holder, preference shareholders, payment to the preference shareholders. So, our final earning is 18 lakh, number of equity shares 3 lakhs. So, earning per share EPS is 6 rupees, EPS is 6 rupees. Now, our formula is P equals to E 1 minus B KE minus BR. So, here we need to calculate what is B. B equals to retention. When dividend payout is given, so 1 minus B already given, then B equals to 1 minus DP, dividend payout. So, earning is rupees 6, 1 minus B, 1 minus B is given, dividend payout ratio is given. This is 25%, 25%. Clear? KE cost is 16%, 1.6 minus B into R, B into G, B into G. So, G is 0.2 yani 20%. So, B here 0.75 into 0.2, the answer is 150, answer is 150. Case 1, when dividend payout increases to 50%, when dividend payout increases to 50%, then this is dividend payout, answer the price of the share will 50 rupees decreased, and 100% dividend payout, at 100% dividend payout pricing of the share will 37.50. So, here it is also proved that price of a share impact or affected by the payment of the dividend. When dividend payout is 25%, the price of the share is 150. When dividend payout increases, then price of the share will changes to 37.5. Conclusion: the bird in the hand theory, this is also the Gordon theory is also known as bird in the hand theory. Malton Gatter revised the dividend model and considered the risks and uncertainty in the model. The bird in the hand theory of Gordon has two arguments. Investors are risk averse and investors put a premium on certain return and discount on uncertain return. This is important. If return is certain, then he can put premium on this. If return is uncertain, then they ask for discount. So, Gordon argument that what is available is present is preferred to what may be available in future. If an investor are rational, they want to avoid risk and uncertainties. They would prefer to pay higher price for the share on which current dividend are paid. Discount rate would vary with the retained ratio. Discount rate would vary with the retained ratio. So, market price, the relationship of dividend and price of the share of Gordon formula is market price is equals to dividend multiplied by growth divided by E minus G, K E minus G. So, in Gordon model, it is quite clear about that if dividend has paid, then the shareholders have expected the prices at lower. अगर डिविडेंड पे किया जा रहा है तो कम प्राइस पे चलेगा, सो शेयर प्राइस कम रहे तब भी चलेगा. तो यहाँ पे आप देखिए when dividend payout is 25%, तो उस टाइम शेयर प्राइस की वैल्यू 150 थी. जैसे जैसे हमने डिविडेंड बढ़ाना शुरू किया, शेयर प्राइस की वैल्यू कम हुई. पर इसका मतलब ये नहीं है कि डिविडेंड देने से शेयर प्राइस की वैल्यू कम हो जाएगी, कंपनी की वैल्यू कम हो. कंपनी की शेयर प्राइस अगर कम होते हैं तो लोग परचेज और कर लेंगे, क्योंकि वो डिविडेंड दे रहा है, बट कंपनीज को ये भी ध्यान रखना पड़ता है, इट्स ऑल्सो टेक केयर बाय द कंपनी व्हेन कंपनी गिव द पे आउट, whenever the company give the payout, in all cases company have to retain something for their future investment, because as a general investors, they always looking forward the process or progress of a company. If company declare 100% dividend, then it is also difficult to retain the shareholder, because as a psychological impact they think आज तो सारा पैसा उन्होंने हमें दे दिया, पर अगले साल क्या होगा, क्या कंपनी बंद होने वाली है, क्या कंपनी के पास पैसा अगले साल के लिए है, क्या वो इन्वेस्ट आगे ग्रो करेगा, क्योंकि शेयर मार्केट लॉन्ग टर्म मार्केट है. द शेयर होल्डर्स थिंक्स फॉर अ लॉन्गर पीरियड ऑफ टाइम वेयर दे इंक्रीज देयर वेल्थ विद द डिविडेंड. they need dividend, but if you give a 100% payout, then it is also difficult to retain for a longer period of time, because company do not have a profit to invest in future. सारा प्रॉफिट तो उन्होंने दे दिया. Therefore, you see IAR is greater than cost of capital, rise the price of share, rise in the price of the share increases when R is greater than K, and dividend payout decreases. जब आपका इन्वेस्टमेंट आपके कॉस्ट से कम होता है, इन दैट केस आपका जो डिविडेंड पे आउट है, दैट डिविडेंड पे आउट है वो ज़ीरो के हो जाता है, नियर अबाउट ज़ीरो. कांस्टेंट R इज इक्वल्स टू K एंड डिक्लाइन व्हेन R इज लेस देन K. आपने जितना इन्वेस्ट किया उससे ज़्यादा आपको कॉस्ट पे करनी है, उससे ज़्यादा आपको कॉस्ट पे करना है. दैट मीन्स आपको उससे ज़्यादा डिविडेंड शेयर होल्डर को देना है, यानी कि आपने सारा पैसा दे दिया. So, in this formula always keep in mind this is very important, 1 minus B, this is dividend payout ratio. sometimes it's given, sometimes retention ratio is given. So, B is retention ratio only. So, 1 minus B is dividend payout. If question is given that dividend payout, you do not need to subtract 1 minus anything, because it is already given. If in question is given that retention ratio is 30%, then dividend payout ratio is 0.70. So, make it clear. So, I just conclude the things. Today we discuss about the Gordon theory, and here he said that it is better to bird in a hand than bird in a bush. He said that investors are always looking for their dividend, investors are always looking for the dividend at present period of time. They are not bothered about anything. So, thank you for watching this video.